If your company is filing an S1 or even just talking seriously about going public in the next 12 months, you are entering the most consequential financial window of your career. Most people focus on the wrong moment. They watch the listing day, they wait for the lockup to expire, they start running the math the week they're allowed to sell. By then, the decisions that mattered most are already made or missed. Today, I'm going to walk through what actually happens in the 12 months before your company goes public, and I'll give you a framework for the 5 questions you need to answer before the IPO date arrives. We'll cover lockup periods and what they actually constrain, the math behind early exercise, the AMT trap that catches people every IPO season, and the decisions that matter most. If you have ISOs, NSOs, or RSUs at a pre-IPO company, this one is for you. Let's get into it. The standard public company lockup runs 180 days from the day the stock starts trading. During that window, employees generally cannot sell shares acquired through their equity awards. People get 2 things wrong about lockups. First, the lockup does not constrain decisions you make before the IPO. You can still exercise options. You can prepay AMT. You can set up a 10b5-1 trading plan that begins the day the lockup expires. You can prepay AMT. You can set up a 10b5-1 trading plan that begins the day the lockup expires. You can make charitable transfers of stock for tax planning. Almost every important decision lives outside the lockup window, not inside it. Second, the lockup creates a structural cliff. When the 180 days hit, thousands of employees at the same company become eligible to sell at the same moment. Many of them do, often without a plan, often into a price that it's already started to move against them. The pattern that works is a written sell plan finalized before the IPO date that takes the panic out of day 181. A 10b5-1 plan is the cleanest version of this. You set the rules in advance. Sell this many shares at this price on these dates. Once it is in place, the plan executes whether you're paying attention or not. That removes the temptation to time the market, which is what causes most of the bad outcomes after a lockup expiration. The other thing that works is sequencing. Most lockup expirations do not need to be a single sell event. You can scale out over 30, 60, 90 days, smoothing the price impact and giving yourself time to absorb the tax math. The plan is what makes that possible. Exercising options before the IPO is not free and it is not automatic. Take a real example. You have 10,000 ISOs with a $2 strike price. The latest 409A valuation is $20. If you exercise, here's what actually happens. The cash math. You write a check to the company for $20,000. That is real money out of your bank account, and you cannot sell the resulting shares to recover it until the lockup expires. The tax math. The bargain element, which is the difference between fair market value at exercise and your strike price, becomes a preference item for the alternative minimum tax in the year you exercise. With a $2 strike and a $20 fair market value, that is $180,000 of AMT preference income from a single exercise. The strategic math is the part most people skip. If you exercise pre-IPO and the company does not actually go public in the timeline you expected, you are now sitting on illiquid stock you cannot sell that triggered a tax bill and that you cannot easily recoup if the company's value falls. When does pre-IPO exercise actually make sense? A few specific situations. If your strike price is very low and the 409A is still relatively low, the AMT exposure is small and the long-term capital gains clock can start running early. If you're confident in the company's near-term liquidity path and you have the cash on hand without stretching your household balance sheet. If your tax advisor has run the AMT projection alongside your other income and the numbers are manageable. If, and only if, you can afford for the company to not go public on schedule and still feel fine about the decision a year later. Pre-IPO exercise can be the right call. It is rarely the right default. The alternative minimum tax is the single biggest tax landmine in pre-IPO option exercises. Here is what AMT actually does. The federal AMT system runs in parallel with your regular tax calculation. At the end of the year, you compute both, and you pay whichever is higher. The bargain element on ISO exercises is one of the largest preference items the AMT system watches for. The rates are 26% on AMT income up to approximately $232,000 and 28% on AMT income above that. The rates are 26% on AMT income up to approximately $232,000. The rates are 26% on AMT income up to approximately $232,000 and 28% on AMT income above that. Those numbers are 2025 figures and should be verified against current IRS published amounts before you act on them. The AMT exemption phases out at higher incomes, which is exactly where most Bay Area tech employees with significant RSU vests already sit. Two things make AMT especially painful in IPO years. First, you owe the tax in the year you exercise, even if you never sell the shares. If your company does not go public on schedule, or if the price falls after listing, you can end up with an AMT bill that exceeds the after-tax value of the stock that triggered it. Second, the AMT credit recovers over time, but the timing is unpredictable. You can only use the credit in years where your regular tax exceeds your tentative minimum tax. For someone with steady high income and no further large ISO exercises, that recovery can take years. Let me walk through what that recovery actually looks like. Say you exercise this year and end up paying $40,000 of AMT above your regular tax. That $40,000 becomes a credit you can use in future years, but only when your regular tax is higher than your tentative minimum tax in those years. If your income is steady and you have no offsetting items, you might recover $4,000 or $5,000 per year. That means the credit can take 8 to 10 years to fully unwind. The cash, of course, is gone in April of the year after exercise. Modeling AMT before you exercise, not after, is the entire game. Run the projection in October or November so you have time to adjust the exercise date, the share count, or the decision itself. 5 questions to answer in the 12 months before your company goes public. 1. Have you modeled the AMT exposure of every ISO exercise scenario, including the cash needed to pay the tax bill in April of the following year? Not a rough estimate, the actual number run through your CPA software or your own. 2. Do you have a written sell plan for the period after lockup expiration? How much you sell on day 1, the cadence after that, whether you were using a 10b5-1 plan to remove the day-to-day decision making. 3. Have you quantified your single stock concentration as of the lockup expiration date? That includes unvested shares, vested but unexercised options, ESPP shares, and shares you expect to acquire through future vests during the lockup window. If you do not know what you're starting with, you cannot diversify out of it. For a Bay Area tech employee with 3 or 4 years of tenure at the company, this number is often well over half of total household net worth before the IPO and stays there through the lockup. Knowing the actual percentage against your full balance sheet is what makes the post-lockup sell plan defensible. 4. Have you increased your federal and California estimated tax payments to absorb the AMT exposure and the eventual capital gains from your post-lockup sale plan? Underpayment penalties on this scale are real and avoidable. 5. If the company does not go public on the timeline you expected, what changes about your exercise decision today? If your answer is everything, that is information about how risky your current plan is. If you cannot answer all 5 with specifics, you are not yet in control of the 12-month window. The IPO is not the moment that decides your outcome. The 12 months before are. The decisions about exercise timing, AMT modeling, and a post-lockup sell plan compound into the difference between a clean liquidity event and a tax bill that lands the next April. If you want to talk through your specific situation, the link to schedule a call is in the description. And if you haven't subscribed to Vested yet, my weekly newsletter for Bay Area tech professionals, the link for that is down there too. I'll see you next week.